Picture this: an emergency meeting inside the US Treasury building. No cameras, no reporters. Just a few people deciding something that could quietly rewrite the rules of the global economy. And here's the part no one wants to admit. It's already in motion. A financial maneuver so technical it slips past headlines. Yet so powerful, it could trigger a chain reaction that slams into every major market. Stocks, bonds, crypto, commodities, all at once. You probably haven't heard the phrase shadow tightening, but you're about to. Because this is the United States' secret move that might crash global markets. Why this matters right now? Let's rewind. For most of 2023 and 2024, countries everywhere were obsessed with inflation, prices rising, central banks hiking rates, people hurting. Then, something flipped. By early 2025, the Federal Reserve, America's central bank, began easing up. They weren't raising rates anymore. Headlines screamed, "Soft landing achieved," "Recession avoided," "Economy back on track." But underneath that optimism, something else was happening. The US government was running record-breaking deficits, spending nearly $2 trillion more than it earned. That meant one thing: it had to borrow. A lot. So the Treasury started pumping out new bonds, hundreds of billions every month. And that single, invisible decision quietly changed global money flows. Because those new US bonds didn't just sit quietly in a vault. They sucked cash from every corner of the world. How the system works. To understand this, imagine the global financial system as one giant reservoir. When the Fed prints money, water flows in. When it raises rates, water drains out. Simple, right? Now, here's the trick. The US Treasury market is like the main pipeline of that whole reservoir. It's where global investors park their safest money. Pension funds, governments, banks, even foreign central banks. So when the US suddenly issues a wave of new bonds, it's essentially saying to the world, "Hey, give us your money, you'll get safe returns." And institutions respond. They pull cash from stocks, from emerging markets, from risky debt, and move it into US bonds. That's shadow tightening. No one raised interest rates, but liquidity vanished anyway. Now, here's where it turns from technical to dangerous. Foreign investors, especially in Europe and Asia, have to buy those bonds using US dollars. To do that, they sell their local currencies and convert into dollars. Result? The dollar strengthens, their currencies weaken, their imports get more expensive. Inflation reignites abroad. It's like the US exporting a silent financial virus, infecting markets that never voted for this policy. By mid-2025, investors began noticing strange tremors. Oil prices swung wildly. Asian currencies slipped 10%. Gold, usually the safety valve, started rising again. The dollar dominated everything. Hype versus reality. Meanwhile, Washington told a very different story. Officials claimed this borrowing wave was temporary, a normal part of fiscal management. Markets can absorb it, they said. But internally, leaked memos told another story. Even US primary dealers, the big banks that buy government bonds, began warning that absorption limits were near. Translation? There are only so many buyers. When supply outpaces demand, someone gets crushed. And the first crack showed up in the bond market itself. The 10-year yield spiked to levels not seen since before the financial crisis. Suddenly, every mortgage, every loan, every valuation began to wobble. Tech stocks that looked unstoppable in early 2024 suddenly plunged 30%. Foreign markets bled cash. And all the while, the public believed the Fed had paused tightening. They didn't see that the Treasury had quietly taken over the job. The global ripple. Let's zoom out. Every major economy, Europe, Japan, China, is tied into US debt in some way. When yields rise in America, their funding costs rise too. When the dollar rallies, their currencies weaken. Their import bills explode. So they're forced to defend their currencies. How? By selling their US bonds to raise dollars. It's a doom loop. As they sell, US bond prices drop further. Yields climb even higher. US borrowing costs rise. And suddenly, Washington's $2 trillion deficit gets even harder to finance. See the trap? Every move to stabilize the system tightens it even more. Uncomfortable math. Here's the math few in government will say aloud. If yields rise by just 1%, the cost of servicing US debt increases by about $250 billion per year. That's more than the annual budgets of NASA and the FBI combined, just in interest payments. At some point, those payments start eating the budget itself. And what's the government's solution so far? Borrow more. That's like paying one credit card bill by maxing out another. It can last months, maybe years, but not forever. Now, imagine a moment when global buyers, pension funds, sovereign funds, central banks, say, enough. They hesitate to buy the next round of US debt. Suddenly, the Treasury auctions fail to attract demand. That moment hasn't happened yet, but history says it eventually will. It's the same silent loss of confidence that triggered Britain's 1992 crisis, Argentina's collapse, and even Japan's bond panic in the late 1990s. Except this time, it's happening to the country that prints the world's reserve currency. The irony? The US built this entire system, the dollar, the debt, the dominance, to make itself untouchable. And now that same system has become the greatest threat to its own stability. Even funnier, in a dark way, is how people interpret each market move. When yields rise, pundits say growth is strong. When yields fall, they say inflation is under control. When both happen in the same week, they shrug and call it volatility. Underneath all that noise, the mechanism stays the same. America borrows, the world funds it, and the liquidity tide shifts without warning. If the global economy were a party, the US Treasury has become that one guest who keeps ordering the most expensive wine, insists, "Don't worry, I'll Venmo you later," and everyone else is too polite to ask if they actually have the money. The chain reaction. Here's what happens next if the current path continues. Step 1. The Treasury keeps issuing debt at record levels. Step 2. Investors keep reallocating into those safe bonds. Step 3. Liquidity drains from everywhere else. Step 4. Asset prices worldwide deflate. Step 5. Risk premiums skyrocket. Step 6. Central banks panic and start intervening again. But here's the kicker. To stabilize markets, the Fed might need to start cutting rates while the Treasury keeps borrowing more. 1 foot on the brake, 1 foot on the gas. You can guess how that ends. Revealing the real strategy. So, was this an accident or a deliberate move? Some analysts believe the Treasury's debt flood is no mistake. They argue it's an intentional form of financial containment. By tightening liquidity globally, the US strengthens the dollar, weakens rivals, and reasserts dominance in capital markets. Especially as China's economy slows and Europe faces energy crunches. It's not a conspiracy, it's strategy. But even strategies have side effects, because every strong dollar crisis of the past from Asia 1997 to Turkey 2018 began the same way, with US policy tightening liquidity faster than the rest of the world could handle. Zoom out to the big picture. What we're witnessing might be the final stage of a 50-year experiment, the age of the dollar as the world's anchor currency. It began in 1971 when the US abandoned gold. It thrived on confidence, compliance, and credit. But today, the debt-to-GDP ratio has passed 120%. Interest costs are exploding, and Treasury demand looks less infinite than ever. The US still has power, but it's forced to use that power more aggressively and more secretly to hold the system together. That's the real secret move. Not a single decision, but a pattern of hidden maneuvers designed to preserve control, even if it risks breaking the machine. So the question isn't whether America's secret move will crash global markets. The question is when the world will realize it's already happening. Slowly, invisibly, one bond sale at a time. Because every empire in history eventually meets the same paradox. The thing that made it powerful becomes the thing that brings it down. And when the next global shock hits, the headlines won't say secret move. They'll call it what it always turns into, a sudden crisis that nobody saw coming. Except now, you do. If you like our video, please don't forget to like, share, subscribe our video. Thank you so much, guys.